morning, I'm Brian Tugend, and this is Markets in a Minute for the week of July 6th. Given the short trading week, I thought we'd focus on some key takeaways from Q2 and what a quarter it was. The S&P 500 posted a 15.2% return, marking its highest quarterly return since its 20% post-COVID snapback in the second quarter of 2020. Gains were pretty widespread across the style box. Even though most of the news surrounded the AI and semiconductor trade, value stocks turned in a quarterly return of nearly 14%, trailing their growth counterparts by just around 3% for the quarter. However, to the likely surprise of many, large caps were not even the top performers for the quarter. Small caps turned in a near 21.5% return, while emerging market stocks rocketed higher by more than 24%. To put this into historical perspective, this marks the best quarter for small caps since Q4 of 2020, and for emerging markets, you would need to go all the way back to 2009 to find a stronger quarter. So what works so well here? Starting with small caps, they benefited from a number of tailwinds, which included attractive starting valuations, economic resilience, as well as a strong earnings season. This helped to entice investors for the first time in quite a while to look outside the Mag 7 for potential value and growth. Now, emerging markets benefited from many of the same tailwinds, but also saw a boost from their exposure to the AI supply chain. More specifically, Korean semiconductor names like Samsung and SK Hynix soared in Q2, a trend we've seen for much of the last year. Now, on the economic front, it was a busy week despite the market closure on Friday. Starting with Kevin Warsh's comments in Portugal on Wednesday, Warsh didn't necessarily say anything new while in Portugal, but he did reiterate the Fed's unwillingness to allow inflation to settle at a level above their 2% target. He continued to stay tight-lipped about the future path of rates, but did mention that he has seen inflation ease over the past few weeks. Unfortunately, this was not enough to release pressure from the bond markets, as yields were higher across the yield curve for much of the day. Now, in terms of the jobs, the JOLTS report continued to be robust, indicating that companies still have ample hiring plans, while layoffs remained low. But non-farm payrolls told a bit of a different story. Markets were expecting a gain of 113,000 new jobs, but the actual number came in at just 57,000, and also included a revision of 74,000 jobs for the last 2 months. Whether or not this is a trend is yet to be seen, but markets viewed it in a positive light. With inflation pressures potentially easing and now some softness in the jobs market, it could open the door for rate cuts later this year, or at least lower the likelihood of a hike. This was priced almost immediately into bond markets, with the 2-year yield falling by around 6 basis points after the release. Now, looking ahead to this week, it's going to be relatively quiet. We still have ongoing talks with Iran around the full resolution to the Middle East conflict, and on the economic front, the big release of the week will be the FOMC meeting minutes on the 8th. That'll do it for this week. If you enjoyed this video, hit the like button, share it with a colleague, and don't forget to hit subscribe. Thanks for watching, and we'll see you next week.